should cope with these volatile markets. Devina, hi, good morning. Great to have you on the show. Devina, that first sign of profit taking across asset classes, and we saw that play out overnight for global equity markets as well. Does it seem like this could be more sustained and not just stop at yesterday?
Good morning. So, we have to look at markets separately because it is not as if all markets move together. Most years that doesn't happen. Most years it is like a giant wheel going up and down, and something goes up, something goes down. Other than 2022, I don't remember a year where everything went in the same direction. And not just remember, we've actually in 100 years hasn't been that kind of year other than 2022. In terms of Indian equities, the only positive I see is that everybody is so negative now. So now everyone is enumerating the risks. They're talking about what could go wrong. And go back a year and a half, there was so much buoyancy. People thought 30-40% compounding was there for the taking. Now we are at the other extreme, and sentiment is a contraindicator, not my opinion. That's all the research studies on sentiment show that when sentiment is at a low, the next period returns are above normal. When sentiment is at a high, the next period returns are below normal, as happened in that last summer, 24 to 25 Diwali, you didn't get any returns. So my guess is 2026 for India might well be better than 2025. That's my that would be my bet in probability terms. Of course, last year India was among the worst performing markets in the globe. It was number 36 out of 42, partly because of currency. In fact, the dollar rupee doesn't quite capture all of it. In euro terms, the Indian market was actually down. And of course, even though the indices in rupee terms had a positive number, the median stock was still down. So there has been a lot of red in the portfolios, and therefore a lot of pain for investors.
Devina, I wouldn't bet against you if you were to call that that we are probably more pessimistic than optimistic. But how much of that pessimism is built in, and where is it built in the most? Is it built in within the large cap basket? Is mid and small looking more attractive relatively, given the kind of setup that we are at and the kind of consolidation we've seen?
See, small and mid cap actually is now a large part of it is actually pretty large cap. So that I would not put in that same category. But if you look at the really smaller companies, whether they're micro caps or the bottom half of the small cap universe, sometimes the pain there lasts a long time. So not just now, I think since 2024, I've been saying on your channel also that if you look at the history of the small cap index, it fell nearly 80% in 2008-9, and then it took 8 years to come back to that level. And that's also only theoretical that it came back to the same level, because the index churns, which is changes 18-20% every year. 8 years later, almost no stocks which were there in the last bull run of the small cap came back. Then again, 2018-19, there was a bull run, then there was a 65% correction in the small cap index. So that's the nature of the beast. It is, at times that 1 year of pain may not be enough. Number one. Number two, what all viewers must remember is that in markets in general, and especially in this category, in the next bull run, it is not the same stocks that come back. This is high risk, means that just remember that of all the stocks that were ever listed in India, more than 2/3 don't even trade anymore. They've gone to zero. So while my recommendation is to remain invested to the extent of your India equity allocation, which should not be 100%, but need not be in the same stocks and sectors where you were there earlier. So my bets would be more sectoral rather than saying large cap versus small cap.
Devina, if that is the case, what is the kind of sectoral allocation that you will give for a portfolio?
So right now, of course, we're in the middle of a rebalance, but as of now, For the last 2 years or so, we have been overweight auto components and then slowly also autos, which has been a good run. We've also been overweight almost the same period, pharma and healthcare, which had a good 2024, not so good 2025, but we remain positive on that space. Last year, slowly we've become overweight on FMCG. Then, of course, I mean, still, even within, let us say, FMCG or IT, where we are slightly overweight now, there have been change in the stocks held. So it's not only at the sector level, because, for example, in IT, now we have little more mid-cap IT than large-cap IT. So that would be mainly, the overweight would be this. Banking, we are not overweight, but we hold more than what we usually do in banking. So last year, first half mostly added PSU banks, later on added some others, also added towards the end of the year, added OMCs, oil marketing companies. Others would be more individual stock picks in chemicals and capital goods and so on.
Interesting you say that, Devina, and I'm quite curious to know what makes you bullish on auto angs. Selectively, they've been quite beaten down. Is it more a bottom-up play, or do you see fundamentally something changing as well?
No, autos, we have been overweight, as I said, almost 2 years. So we might review it again in this rebalance. So they had a good run through 24 and most of 25 also. As I said, it was mainly auto components to start with, and then we added autos a bit later.
Sure, I was specifically wanting to know about components, but Devina, I have to talk about budget. What can it do to change market sentiment?
I don't envy the finance minister her job, because this time it's a very tough job. You know, all of us are like Oliver Twist with more, asking for more, whether it is tax concessions or investment in our particular sectors, depending on which industry we're talking about. But the reality is that tax collections are way, way below budgeted numbers. So that's the big thing which I don't think people have focused on enough. I mean, I can give you a more detailed breakdown, but the main reason, of course, is that the nominal GDP growth has been so low. So nominal GDP growth, as per the ministry's own expectations, is supposed to be little over 8%. To give you some sense, in the last 20 years, the average has been 12%. We've never come in this range of 8-9% ever. Whether it is corporate profits or it is tax collections, they are tied to the nominal number. So the real GDP, the headline number looks good, but the nominal GDP has been very sluggish, and tax collections have been even more sluggish. And part of the reason is that last year, and this is I had pointed out at the time of the budget itself, that at that time the nominal GDP growth was budgeted to be over 10%. So therefore, GST and corporate tax you had budgeted at 10.5, 10.7 or so. But personal income tax, where rates were cut last year, the government had budgeted a 14.5% growth. Now that to me stood out even then, that how will this happen? And the only explanation can be that the government was budgeting a lot of money from the capital market related taxes, which obviously didn't come to pass. At the gross level, personal income tax has grown only about 1%. STT, which was supposed to grow 40%, has hardly grown. And of course, this year refunds have not been coming through. But even on a net basis, against a 11% tax growth budgeted, we are at 8%. And if that continues, there's going to be a 1.3 trillion shortfall. That's a big amount. And therefore, unless the government lets the fiscal deficit go, there has to be some cut somewhere, or at least, the increases have to be much less generous. And remember, government spending has been the big engine driving the GDP growth in the first place. So government capex over the last 10 years has gone up 5 times. Everything may not have been in that productive thing. So there might be scope to cut, but if you cut, that impacts the GDP growth. So I would think, as I said, I don't envy the finance minister her job this time.
Oh, yeah, it's going to be a tightrope walk, which we'll figure out on a Sunday this time. But Devina, great to be speaking with you. Thank you.
Thank you.